Welcome, welcome, welcome to the final day of our final edition for 2023, our live trader showcase. This is a quarterly event. This is Sherry, of course, your hostess, and this is a quarterly event where we feature expert traders to bring you trainings, tips, hints, and insights from many speakers. This time we happen to have 20. Prize giveaways. Please check out tradersexclusive.com where we put up our posts and our articles and video clips that have nuggets, golden nuggets for you to learn new trading tips and techniques. Before I get started, I do have to do the disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance, of course, is not necessarily indicative of future results. This is our lineup for today. Michael, Daniel, Kenny, AJ, Michael again, Harry Boxer. Then if you need to reach me, it's support@tradersexclusive.com. And I want to thank our December sponsors. We have blue chip sponsors, Market Taker Mentoring, Hit and Run Candlesticks, and Vantage Point Software, Vantage Point AI, and also Mumu. Bring in now AJ Brown of tradingtrainer.com. He's going to give us a behind the scenes look at how he creates a 7-figure income selling options and how you can too. He was born and raised just outside of DC. He attended Thomas Jefferson High School for Science and Technology. He went on to study at the University of Virginia, where he graduated with 2 engineering degrees, mechanical and electrical, and a minor in commercial business. AJ then pursued graduate studies at the University of Arizona before becoming a marketing strategist employed by several large corporations in both the United States and Canada, including Agilent Technologies, which is Hewlett-Packard, in Silicon Valley, California. AJ became a protege in Robert Allen's multiple streams of income program. Along with 9 other investors, he branched off from the protege program to study with various other real-world mentors who had succeeded in the stocks and options markets. Now, for over 3 years, AJ diligently recorded his observations and interpretations of the day's markets in a nightly email to the original group from the multiple streams of income program. Fascinated with the possibilities that options trading offered, AJ took on a challenging experiment in February of 2004, where he started with $5,000, and 1 year later, after only trading options, he had turned that into $376,000. Wow. Nice. So at that point, AJ founded the tradingtrainer.com community where beginners and experts alike could come together to work with him in making significant profits from their investment dollars. AJ currently teaches options trading and covered call writing in public and private workshops, as well as through the tradingtrainer.com community website and newsletter. His down-to-earth dialogue with students and his sense of humor make learning how to invest enjoyable. Thank you very much for joining us, sir. And
I hope you guys have some either some note-taking devices, or if you're taking electronic notes, because my presentations tend to be a little bit of a learning presentation. So I want to jump right in. I'm going to start by sharing my screen over here.
Now, do you like to see the questions on the fly, AJ, or do you want them held to the end?
It's okay either way. I may not get to them until the end, but if they're popping up, that's fine too.
All right, so give me a second. When I make you an organizer so you can see that, it's going to knock your mic out for a couple seconds. So just a second.
Okay.
And you're back. All right, I'm going to mute myself. Take it away. Thanks so much for being here.
No worries, no worries. And I think you guys are seeing me. I always like to have my little picture up because I like talking to you face to face. But if that's distracting, there are settings on your meeting interface there that you can move me out of the way and look at my screen. I'll also be sharing some live examples as well as some presentation examples, some theoretical examples, so that we can get our thoughts through. The presentation I'm doing today is called A Behind the Scenes Look at How I Created a Seven-Figure Income Selling Option. So let's get right into it. And I might go a little bit fast because I realize I'd love to get everybody up to the pace, and I feel like we started a little bit late. So I'll try to speed up. So be ready to take some notes, whether they be in pen or pencil. If you're using pen, well, then good for you and your confidence. Hey, I got some facts to throw your way. First of all, a lot of uncertainty with what's happening in the world right now. As you know, the market's kind of been on this little rally since the end of October, beginning of November, but will that proliferate into a full-on uptrend, or will that actually see some pullback going into 2024? It's yet to know. The transition's happening. It's very difficult to be trading directionally right now. Just as people are getting onto this uptrend, it could actually pull back. There's a lot going on, but if you focus on the markets itself and you play it right, you can actually be set up for months, if not years to come. Because one thing you have to remember is that money is it's not created or destroyed in the markets, despite what the talking heads out there have told us, right? You'll hear news headlines like, oh my gosh, $4 trillion was erased from people's portfolios today. That's not actually true, right? We know that the markets are just a place where money changes hands. And so the key is making sure you're on the correct side of that equation, right? And so that's why I personally have always been attracted to options, right? Because options allow you to be able to look at whatever's happening in the market, and then through combinations of options and also the option selection itself, meaning the strike price and the expiration date of the different options you use to populate your strategies, you can get these things to do whatever you want based on what patterns you're observing. You're not stuck to just buying low, selling high, or if you're elegant enough, selling at a high and then buying back low. Those are just two strategies. Option traders have like 27 different patterns that they can profit on if they know how to wrangle these things, how to pick the correct tool in their toolbox to apply. Before I get started, I always like to ask people, so I can like tune the presentation accordingly, what would be ideal for you? Are you here because you like to learn how to invest for low risks and high returns? In other words, you like to learn how to fish and be 100% self-reliant? Or are you somebody who likes to learn how to invest and have seasoned investors along with you in your journey, reviewing what you're doing and making sure that you're not going to take any missteps, right? Making sure you're on the right path before you take each step. In other words, I call you somebody who likes to learn how to fish, but also have expert fishermen around in order to help them. Or maybe you might fall into the category of somebody who just likes to follow what seasoned investors are doing. In other words, you like to fish alongside expert fishermen and kind of copy their moves, do what they do. Or maybe you're here for some other purpose. If you don't mind just throwing into the chat area, I'm going to pull that chat area here in front of me. Let me know whether you're at A, B, C, or D. That'll help me tune my following kind of presentation. Okay, a lot of you are putting A, but I am seeing a couple of people being honest saying that they're C's or B's. That's fantastic. I kind of know where to take it from here. I always do this, and I know you've seen this analogy many times in your life. Humor me, and I am going to point out a couple things as we go through this scenario just to make sure you've got a different view on it. Which would you rather take? Would you rather take $50,000 in cash right now, no effort, nothing else, just 50 grand, or would you take a penny that doubles? But I want to put a contingency on that. You have to stick with the doubling process throughout the month. And there is some skill and effort in that doubling process, right? So which would you take, the penny or the 50,000? Well, let's go through the scenario. You know what 50,000 is. That's free and clear. Take it, run, you're out. But if you take that penny, gosh, okay, we're following the process, and realize every day you're having to go through your recipe, follow your rules, do what you have to do, your process. There's a little bit of skill involved. There's a little bit of artwork involved. There's a little bit of science involved. Great. Day 7, you've got a whopping 64 cents. I mean, if there's 4 weeks in a month, you're a quarter of the way through the month and you're not even over $1. Boy, that $50,000 is really looking kind of scrumptious right now, isn't it? Going to day 10, that's about a third of the way through the month. Remember, I'm asking you to stay disciplined, stay focused, not be distracted by the latest shiny objects, and you got $5.12 to your name. Okay, day 14, we're about 2 weeks into this process. That's about halfway through the month if a month had exactly 4 weeks to it, like a February might. And you've got a whopping $81.92. My question is, have you been able to stay disciplined? Have you been able to stay consistent despite not getting that instant gratification, that, being able to see that money compound the way you wanted to? I mean, $50,000, you almost feel like you've got, buyer's remorse here, but let's keep going. All right, we are now at 3 weeks. Gosh, 3/4 of the month is already over. We are up at 10,000, just under 10,500 bucks. But here's the big point. You had to stay consistent in your efforts despite not seeing any returns for like 3/4 of the month, even more. You had to go to day 24, more than, you're almost done with the month and you finally got more than $50,000. And it's this payback at the end of the month where things really take off, where the compound, in fact, at the end of the month, you're over $20 million from that penny. So this is that idea of compound interest, but it's also the idea of, can you stay focused, especially when in the beginning you don't really see the fruits of your labors, right? It's a marathon, not a sprint. And I don't know if Albert Einstein actually said that quote. It's often attributed to him, but compound interest is quite powerful. Now, I'd like you to take a look at this picture I threw on the screen. I'm actually going to revisit this in a few minutes, but notice a couple of things about what you're looking at. First of all, as you go from the left-hand corner to the right-hand corner, it's not linear, right? It's not a diagonal line. It's a exponential line, right? You'll also notice right about here, let me see if I can pull up my marker. Got it. This is our zero line. It's not labeled very well, but there's a range high and there's a range low. And notice that the range low surpasses the zero line quite early on in the process and then goes up, meaning whether you go to the low side or to the high side, you still wind up with positive returns. Let's revisit this, but I kind of wanted to get this seed planted in your mind. Now, if you wanted to double your money every day, like we talked about with the penny, I mean, people probably have talked to you about trades where they have doubled their money every day. But to be honest, having been in the trading world now for over 25 years, I can tell you that having a trade that consistently doubles every day, well, that's quite unique, right? In fact, you might get a trade that doubles once in a while, but you factor that in with the trades that don't go your way, and it probably comes out in the wash at the end of the day. But here's the scoop, right? If we want to get a more realistic goal, what if we reverse engineer, not even with compound interest, but with simple interest? If we focus on 6% on our trades every month, then at the end of the year, our portfolio, our investments will more than double, right? So what does that mean? Well, a lot of folks come to my program with like roughly about $1,000. That's a common starting point. I've seen people start with as low as 800. Remember, we're talking about investing and trading here. We're not talking about get rich quick schemes, right? Or zero down schemes. We're talking about something where you're taking money that you have, whether earned or given, and you're parlaying it into bigger dollars using trading and markets and investments and things like that. So you do need money to get started, right? And the more you get started with, the better off you are, right? But say you start with $1,000. then that means in 12 months, you've got a little bit more than $2,000. If you're focusing on that 6% per month, $4,000 in 2 years. In 5 years, we're talking $33,000. And in 10 years, you'd be a bona fide millionaire. A little footnote here. When I was a kid, right, I just turned 50 this year. My birthday is May 20th. If anybody wants to send me anything, or every time May 20th rolls around, I just turned 50 years old this year. And when I was a kid in the late 70s, early 80s, a millionaire, you were like, wow, he's a millionaire. Nowadays, thanks to inflation over the years, the real goal is to be a 10 millionaire, 8 figures, right? So keep that in mind. But 10 years, starting with $1,000, you'd be a bona fide millionaire. But even more, what I like is, I don't know if you knew this, but the average salaried income in the United States is $87,000, right? And that's for a 40 to 60 hour a week job, giving your time to somebody else, and you're getting this salary of $87,000. And now I know if you're on the left or the right coast, you're making a lot more than that, but the average is 87. But if you grow your portfolio to $1,000, let your money work for you, $100,000, then focusing on 6% per month, that would generate more than the average salaried income employee makes in a year. So that's kind of a little thing you can do. This is what my family and I have been doing for years, is we live off of our portfolio, and any extra that we generate every year goes back into the portfolio to work on next year. So something you can do if you're thinking about future planning, right? So what is it that I'm talking about today? It's called selling theta decay optimized option premium. Now that's a lot of freaking word salad, right? What are we really saying? We're profiting on the component of options that work with time passing by. So a lot of people use options as leverage devices, right? They look at an underlying symbol, they try to figure out whether it's going to go up or down, and then they'll use the respective option to kind of turbocharge that movement. So that's one way to use options. Another way is options are expiring contracts. They have expiration dates, and they actually have a theta decay or a time decay curve, and you can profit off of the fact that they lose value. If you're a seller of options, you can profit on the fact that they lose value over time, and that's what we're doing, right? So my quiz questions are going to get harder as we go, but I just wanted to see if you were paying attention. What minimum returns, what must we make monthly on our portfolio in order to more than double our money annually? A, 0.5%, B, 1.5%, C, 5%, D, 6%, or E, 10%. What do you think? I'm looking at the chat box. You guys are getting the right answer. It is indeed D. Thank you for listening. Let's keep going. Now, a lot of people say you're talking about options. I keep hearing that options are risky, but it's actually the exact opposite so long as you use them responsibly, right? If you think about stocks, commodities, Forex, right? Indexes, ETFs, even baseball cards or paintings or antique cars, these things are all about buying it at a low price and hopefully selling it at a high price, one strategy, and being able to guess on or speculate on which ones are low and which ones are going to be high in the future, right? Now, if you're elegant enough with some of these investment vehicles, you know how to borrow them, sell them, and then buy them back at a lower price, make money on the price going down, give them back to whoever you borrowed them from. That's called shorting. So now you have two strategies. You can make money if the price goes up, make money if the price goes down. But what I like about options is you can make money if the price doesn't do anything at all. And if you look at a lot of candidates on people's watch lists over time, a lot of candidates like to go sideways, maybe sideways choppy. This is a great way to figure out how to profit off of them, because options also profit on time passing by. That's my big emphasis. In fact, if you're really elegant, you know that options go up in price, at least some options go up in price when there's fear in the market, and they change price as well if there's confidence in the market. So you can actually, like I said, options work in all these different ways. There's a lot of influences on their price depending on which options you choose, which strike prices, which expiration dates, just a little bit of common sense and knowledge, and you can get all these patterns to work for you. In fact, like I said, there's 27 different ways to trade options versus just the one or two ways to make money on things going up in price or down in price, right? So I think it's the opposite risk. In fact, they were created in the late 70s, early 80s for big money people, market movers, to be able to hedge themselves against risk. So some people like to get into the weeds. What are they? They're called derivatives, right? They're like in the same family as futures are to commodities. They're typically bought and sold in order to hedge against risk. But what we're doing is we're selling their premium to generate income, right? So you might want to write that down. Selling option premium to generate income. Now, I already got that really fantastic introduction, so I'm going to quickly go through these slides, but I'm not going to spend any time on them. If you ever want to check me out, you can go to YouTube and search for my company name, Trading Trainer. That's TRADING, TRAINER, or we've got some links on the board. We've got a podcast that we do. In fact, I just got off of the AJ Brown show that we do every Friday at 11 a.m. Eastern time. I think that's 8 a.m. Pacific time. Got Facebook, we've got X, which used to be called Twitter. I've written a ton of trading articles and white papers over the year. And if you ever want to get a hold of us, just jot down that phone number and that contact us link. By the way, if you do visit us on any of those socials, do me a solid, give me a subscribe and a like. That really helps us, and it helps us get our information out there. We already talked about all of this stuff. Thanks to that beautiful introduction. You often see this home study course that we did in 2008 on a lot of successful option traders' shelves. I'm pretty proud of that. One of the other things that I just want to let you know is when I first started out in the 90s with that whole multiple streams of income thing, I lost big. In fact, when I started, I wound up spending $27,000 on seminars. Back in the late 90s, I think there was WebEx, but the web was just fledgling at the time. Not a lot of these over the web meetings. And so what they would do is these different teachers would invite you for a Saturday for like 4 hours on a Saturday to learn about something. And then they'd get you to buy, come back on Sunday, pay some money, come back for all day Sunday. And then by the time you got to the end of Sunday, you had shelled out a couple $1,000s, including a plane ticket to go somewhere. And you guys might remember that type of model. And I did that a lot. And it was thankful that I had a job in Silicon Valley making some good money. I didn't have a mortgage payment. In fact, I was renting a place with a bunch of guys, and I didn't have a family, right? So I had money to spend, but man, when I think about how much I spent on my engineering degrees, and the fact that not only did I spend that money on the actual education, I wound up giving $85,000 back in that year towards really crappy trades, trying to follow what my teachers taught me. That was more than I spent on 3 degrees from universities. Now, of course, universities have gotten very expensive over the time, but that was just quite, I chalk it up to, getting yet another college education, right? I look back at it and I'm like, I can't believe that. But the scoop is I came up with 4 shortcuts to be a successful investor. So you may want to write these down. Get your pen ready. Number 1, stop chasing shiny objects. In other words, settle on one type of investing and learn it really well, right? That's really difficult with a lot of the marketing messages out there these days. They're really enticing. What I challenge you to do is take inventory, not even of what you want and what you think you'll want in the future, but what is your lifestyle going to support right now? One thing for me, the reason why I went for options is because I have a lot going on, and I've always had a lot going on, and I can't sit in front of a computer and be a active trader during the day. I have to be an end of day trader, somebody who comes back for maybe 15, 20, an hour every evening on my own time, figure out what's going on, set it for the next day, and then forget it. And just do this in the evening. I can't be a day trader, right? And so that's something that you have to keep in mind. What would your personal situation with options? You can analyze the markets after hours, find the right strategy, set it on your automatic trader, forget it, and just come back in the evening on your own time. And that's why what attracted me to these very flexible instruments. But whatever it is for you, figure it out what it is. They all, I've found teachers over the years who do Forex, who do all the different investment vehicles, and they're all fantastic and they're all successful. So just make sure you find something that fits for you. I've had people who had me train them, especially in the 2010s and 11s when the market started to recover after the 2008 recession, almost depression. And they wanted me to train them to be full-time options trader. And so I did. And then I checked in with them a couple years later, and none of them were using many of them were not using the strategies that I learned. And I asked them why, and they said, we found out we had intentions to be full-time options trader, but that's not what our lifestyle supports. So just be honest with yourself and make sure you match what you're going to pursue with who you are and what is your lifestyle, not just what you want, okay, or what the marketing entices you. Number two, hire a mentor who is currently doing what you want to be doing, right? Not somebody who doesn't do it anymore, because there's a lot of folks out there who haven't done what they talk about doing for many years now, right? Get somebody who's doing it right now and that has the ability to teach. I learned that one because I hired a coach once for trading, and they were super successful, and they would show me their portfolio and real time, and couldn't teach to save their lives. I couldn't pick up what they were broadcasting, right? So keep that in mind. This is called learning from guided discovery. I suggest nobody do what I did. I didn't have a profitable year until 2001. Now, if you do the math, I started in 1997. That's 4 years that I struggled, right? A lot of the people in my program, they're up and running within a couple months, right, of good practice and working with us. So we shortcut this through guided discovery. Trial and error is a great way to learn, but it sure is long and sometimes costly. Join an investment group. Look over each other's shoulders and leverage with pride. That means, if somebody's doing a good investment, don't be afraid to do the same investment. At HP, I learned something, right? In school, they told me never look over people's shoulders, don't cheat. And I almost think that that was a crime, that they tried to instill that in me. At HP, what we used to do is we used to buy people's like Canon and Epson's printers. We'd take it apart, reverse engineer it, find one thing inside that we can incrementally do better. That was a new HP printer product, right? And that's called leveraging with pride. And it's done all the time in the world. In fact, that's the way that we progress, is building on what somebody else has done. And that's what you should do. You should get yourself into an investment group and not be a lone cowboy out there, or a cow person in the world. And finally, make sure you surround yourself with like-minded investors, right? Naysayers will always try to convince you that what you're doing is wrong, right? Make sure you have somebody there that's going to celebrate your wins, but also tell you when you have a loss here and there that, hey, it's good, it's going to be better the next day, and not get you to have the ups and the downs. This is exactly how I got to be successful over those 4 years. Also, just know that I have this cool foundation that I started in 2003. This is where I took historically underserved, I still take historically underserved inner city kids, and I teach them the same programs that I teach the folks at Trading Trainer, right? In fact, that first year in 2003, we had to go to a public library, and they only gave us 30 minutes a day on a DSL line. There was no such thing as fiber optic or anything to the home. We had digital subscriber lines, DSL lines. And these folks did it after a 6-month program. I gave each of these 9 original folks $2,000 of my own dollars, thinking I'd never see it again. They all paid me back. At this point, years later, one of them is a professor at DU. All of them went off to have really successful lives. And we've been doing this every year. In fact, now we've moved it from where we started in the suburbs of Denver, Colorado. We're now in the south side of Chicago. You may have heard of that area. There's a lot of historically underserved folks there. And we graduated 100 people last year. So this is where a lot of me and my coach's time and the money from Trading Trainer, the company that I started, we put it all into this little nonprofit that we started. We all, my coaches and I, live off of our portfolio profits. We do this because this is going to be our legacy, our name that lives on past what we do. All right, back to the topic at hand. How do we sell premium? Get your pencils ready, pens. We focus on 4 simple transactions: writing covered calls, writing covered puts. A lot of people don't know, can't wrap their mind around covered puts. I strongly urge you to take some time after this event that Traders Exclusive is putting on and pursue writing covered puts. Get your head around that, because it looks like 2024 is going to be a good time. And I'm not talking about naked or cash secured puts. I'm talking about covered puts. This is flipping the covered call upside down. Get that in your tool chest. Also, I call supercharging it for you academics out there. If we substitute the stock in both covered calls and covered puts with a back month option, it becomes a covered call that's supercharged, or a covered put that's supercharged. The academics out there, we're talking about bull call diagonal debit spreads, or a variant of bull call diagonal debit spreads and bear put diagonal debit spreads. So now that you have those 4 written down, make sure you mark the covered calls, the bull call diagonal debit spreads, the bear put diagonal debit spreads as cash trades. Right? A lot of my program participants do this in their retirement accounts to take advantage of tax-free, tax-deferred benefits. And almost all of those accounts, unless you're doing something really squirrely, are cash trading accounts. So you need to have cash trades, the type of trades that are cash. This guy called a cover put does require a margin account. So make sure you know about those 4 transactions that we're talking about. Talking about option premium, right? It's equal to 2 components. So when you look at the big board, whether it's through your electronic trading platform or if you're watching it on TV or something, and you see the option prices going by, realize that each of those option prices has 2 components that make it up. One is called the in the money value, or for you academics out there, the intrinsic value. And the other one's called the premium value, or the extrinsic value. And so we focus a lot on that premium value, right? So here's an example of how we sell premium. I looked up the prices on Lyft when I put this presentation together a couple nights ago, and it closed at $12.21. Lyft is that rideshare company that competes against Uber. $12.21 a share. Now what we can do is buy that stock and then sell back the Lyft January 19th, 1250 call. Right? We consider this a near-term option, meaning that it expires in about 3 to 5 weeks, around that sweet spot there. And it's slightly out of the money. Pretty much it's basically at the money. And we get an 85-cent credit. That acts like a discount. So we reduce our break-even price on the Lyft stock because we just got some money back. It acts like a rebate check. It also, because there's an expiration date of January 19th, this is going to act like a coupon, an expiring coupon. You know, when manufacturers give you coupons and they have that expiration date, if you don't use that coupon by the expiration date, the manufacturer actually gets to get that money back, right? Also, I like to think of it as an instant dividend or an instant cash back. And you'll notice I said $85. That's because option shares are sold in lots of 100 called option contracts. So for every contract we sell, we get $85 of cash back. So let's run through the scenarios. If Lyft closes above that $12.50 strike price on January 19, well, we spent $12.21 per share. We got $12.50 for getting exercised out, so that's a 29-cent profit. Don't forget that we got the 85-cent profit up front for getting that instant dividend. And so that gives us a $1.14 profit per share, or a 10% ROI. Remember, I'm focusing on 6%. 10% is even better. But now here's an even better scenario. What if Lyft is flat, right? Going sideways by January 19. We spent $12.21 on each share of Lyft. We got 85 cents back. The option expires worthless because nobody wants to exercise it if it's going sideways. So we keep that 85 cents. We've made 7.5% ROI so far, but what's really nice about this is we can do it again and again and again. So we only had to research the underlying symbol once, and on average, my program participants and I, we get to stay in our positions about 5 cycles or 5 months, collecting premium every month, right? That's the average length of our trade is 5 months. So I like this scenario. And again, 6% is my target, 7.5% is even better. Now, of course, what if Lyft drops by January 19th? All right, so we spent $12.21. We got that 85 cents back. That lowered our break-even price to $11.36. That means that the stock would have to drop all the way to $11.36 in order for us to start trading in the red. We call that a profit buffer. Now stay tuned. I am going to show you a way that we can reduce the risk on return even further using some active, adjustment trading strategies. But even built into this covered call writing strategy, we have a profit buffer. Now I do want to show you a quick trade. And again, I'm being careful with my time here. Can you guys hear me okay? Somebody said there's no sound. Check 1, check 2. It looks like I'm going okay. So I'm going to keep going. This is a trade on ticker SLV. Now this is a ETF that follows the silver price. On October 9th, my participants and I bought 500 shares, so roughly about a $10,000 investment. And then November 1st, so this is called legging into the position. It's where we do the 2 different transactions instead of on the same day, called a buy right. We take our time and we kind of time getting into the stock and then selling the premium. So November 1st, we sold that premium for 37 cents, 5 contracts. Remember, each contract is 100 option shares. And then sure enough, on November 17th, that option expired, but it was in the money, so we got exercised. We got exercised at that $21 strike price. So we got the $21, the difference there was $1, plus we got the 37 cents. After commissions, we wound up with a profit of $1.36 per share, or we walked away with 6.8%. And my favorite part is we really only did 2 transactions. This is not like day trading. We did 1 transaction on October 9th, and then on November 1st, and then these transactions happened automatically on the expiration date. So this was really an effortless trade, and this is an example of what happens when you get exercised in real life. All right. So what do we get when we sell premium? Let's see how many people were paying attention. A, B, C, or D, and actually I put in here answer all that apply, so there might be more than one answer. Is it an instant dividend? Is it a discount on some sort of index ETF or stock? Is it a profit buffer, or does it act like an expiring coupon? What do you think? Again, it could be more than one. A lot of people are answering. Let's see what the answer is. If you thought it was all of them, you're absolutely right. Now I'm going to start asking you questions ahead of my explanation. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we be selling farther out in time options? Should we replace the security with options trading at parity? Should I just give up and start going with mutual funds, or is what I'm talking about not possible? What do you think? A lot of people are saying in the chat, sell farther out in time options. Let me just tell you something. As you go farther out in time, the time decay component gets less and less. In other words, when you sell an option, you put yourself into a little position where you have an obligation to perform. not a bad thing. But each time you allow that obligation to perform extend in time, meaning you're putting the expiration date further and further out in time, and the benefit gets less and less. So really the sweet spot, write this down, 3 to 5 weeks. Sometimes you can go less than 3 weeks, but we really don't want to go very much farther than 5 weeks out. So let's cross out sell out and time options. And this, comes with the understanding of, what the different expiration dates mean for options. But farther out in time, the increased risk does not outweigh the increased benefit. So it turns out it's actually B. We're going to replace the security with an option trading at parity. Now you might say, what the heck are you talking about? That's, again, a lot of word salad. Option premium, we've already figured out, is the most when the option is at the money. But when we go really deep enough in the money, the option has very little premium, right? It's almost completely in the money or intrinsic value. So that's where it's locked dollar for dollar with the security, right? A deep in the money option behaves exactly like the underlying security, moving dollar for dollar, only it comes at a cheaper price. This is where we incorporate a little bit of leverage into it. Now, you are substituting a stock that doesn't expire with an option that does expire. So how far out in time should we go? What we want to do is make sure that that option that we're using as an initial covering position isn't going to expire when we've got this monthly, or if you're using weekly options, it could be more than that, this income machine going. You don't want your main cash cow to expire on you. And so I told you that on average, our positions last about 5 months. On the outliers, we don't have many positions that last more than 8 months, right? And so 8 months is kind of our cutoff. So we want to go at least 8 months out with this back month option. And we typically go even further and use the leaps because leaps often have a lot of liquidity. So right now, 8 months puts us in the July-August timeframe of 2024, but you might consider going to the January 2025 option depending on the liquidity of these different option series. So here's that example with Lyft again. I could use Lyft stock like we used in the last example, but then I found that if you go to the Lyft July 19th, 2024 $5 call, it's just slightly higher than half the price of Lyft, and this thing acts dollar for dollar. So when Lyft goes up $1, so does that back month option. It's locked almost, right? Specifically, this in the money option is 96.8% in the money, and there's 3.2% of that premium emotional component of the price. So if we run through it, instead of buying the stock, we buy that back month option for $7.45, and we get the 85 cents for the front month option. We get our instant dividend. It acts as a discount, all of the above, but now we're doing it on a cheaper initial investment. Running through the 3 scenarios. I spent $7.45. I get $7.50 back. Now that's because we're talking about a spread now, and the spread is the difference between the 2 strike prices. The 2 strike prices are $5, $12.50, so you get the difference. $7.50 back, which is a nickel profit. Don't forget we got the 85 cents up front. That's 90 cents, which winds up, because it's a less total investment up front, 13.6% ROI if we got exercised. I like that middle scenario the best. What if it goes flat? I spent $7.45, I get 85 cents back. I keep the 85 cents. That's 12.9% ROI so far. I'm going to do it again and again and again. And finally, it does have that profit buffer of 85 cents. So the back month option would have to drop all the way to 660 in order for it to even be trading in the red. Now I am, like I said, going to show you a way that we can, cut off that risk on return even more. But just know, built into this bull call diagonal debit spread, which is what this is called, there's already a profit buffer built in. course, I'm going to show you a live trade. This is one where we also got exercise. This is on AT&T. So on AT&T, October 20th, we bought those AT&T options. They were trading at $5.80 a share. We bought 20 contracts for an investment just under $12,000. We got 8 cents back on November 9th. On November 17th, these things expired. They wound up expiring so that we got exercised. The difference between the strike prices of 10 and 16 was $6. We actually walked away with an ROI of 4.5% ROI. Can't get better than that. You might be saying, what about 6%? Look, I sold my premium on November 9th and it was about a week later. So this is a weekly return, right? 4.5%. You do that every month, right? Or every week, and you're talking about 18% for the month, right? So that was actually a kind of a fun trade too, because it was a fast money maker, right? Hold your money for a week, and it turns out being really profitable. Nobody's making that kind of dollars on a consistent basis. So again, focusing on that 6% so that our investment doubles every year. All right, last component, and then we'll button up our presentation. How can we drastically reduce our risk on return? What do you think? Should we start by selling half as much option premium? Will that reduce the risk? Or should I sell farther out in time options? Or should I be collaring the investment by marrying a protective option, or is what I'm talking about not even possible? All right, I see people getting the right answer. We're going to put in a protective option trade. Now, this is quite unique. In fact, I'm going to show you with a live example. Remember how I told you not many options last past 8 months? I had one trade over my history that lasted 14 months, and that was very rare. It was on Pan American Silver, right? So I bought the shares of Pan American Silver for $34.73 per share. 600 shares, roughly a $20,000 investment, right? I sold the premium, $1.76, and then turned around and bought a protective put at $4.75. Now, this protective put was a couple dollars. It was below where this thing was sideways channeling, so that if it came and broke out of the channel, this protective put would kick in and offset any loss that I was getting with a gain. Guess what happened? When the expiration date rolled around, I got to, it expired worthless, so I got to keep that $1.76. And since I didn't need that protective option anymore because I was no longer in a sold premium position, I was able to sell back that protective option for a profit, right? So one of the things that's slightly different here than what usually is talked about is a lot of people hedge their positions with protective options, and those protective options become kind of losses or costs to the overall economics of the position. By timing it and putting on the protective option only when we need it, when we have premium sold, we actually can turn that trade not into a cost center, but into a profit center. So we actually roll out the protective options when we no longer need them for the next protective option at a profit. So not only on this first cycle did we make $1.76, but in the rollout process, we made an additional $1.15. It's like the frosting on the cake. And then we did it again. We made $1.47 by selling premium. We bought our protective options for $3 and a penny. The premium expired worthless, meaning we got to keep the $1.47, and then we sold back the protective options, in this case for 61 cents a share. So again, 2 sources of profit instead of 1 at every cycle. And we just kept going, rinse and repeat, rinse and repeat, rinse and repeat. And these are the trades that we actually like to set up. The other thing, and notice if you look at the transaction dates, we're doing like 1 or 2 transactions a month. It's not like we're in there day trading every day looking for the perfect signals. 1 or 2 times a month, we're rolling out our options, we're adding new adjustments. These are just adjusting the main position. But the other thing I want you to look at is this break-even price. And notice when the break-even price gets less than the protective option price, right? The protective option price is $34. Think about it. When you have an insurance policy that insures your asset for more than it's worth, you now have basically a risk-free situation. If you lose the asset and the insurance has to bail you out, they're going to give you more money than you put into it, right? What is that called? Think about that a second, right? This is that trade. So I graphed this trade when I did it, and notice there's that break-even price, right? This is the average time that we stay in our trades, about 5 months. And so notice whether the position gets stopped out, right? The position directionally goes against us, or the position goes for us where we get exercised. Well, if you get exercised, you're going to get 65% ROI after 5 months. But if it goes against you, you still make money, right? You get 50% ROI. So here's a case where people are always asking, what's your win to loss ratio? It doesn't really matter in this case because we're letting the option time value pay us. So if the thing works against us, against our technical patterns, good. I'll walk away with 50% instead of 65%. In fact, the longer that the position stays, the more profit I make. It's exponential versus linear. And so here's the key. This is the break even. So long as I can hold my position about 1 cycle, 1 to 2 cycles, 1 or 2 months, I have a position now that so long as I just keep it going, whether it goes against me or goes for me, it's going to be a profiter. It's like a risk-free investment. So what do we have when our break-even price is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Too much complexity? Do we have a pipe dream? What is it? What do you think? A lot of people are answering, and a lot of people are getting the right answer. This is a risk-free investment. So that's really what this whole thing is. So if we summarized it, this is what I talked about today. Number one, I want you to buy or short an underlying security, a stock, an ETF, an index, or if you want to even do it better, buy a substitute option that's trading at parity. Then we're going to sell near-term at-the-money options for their premium value, get that instant dividend, and create that profit buffer. And finally, we're going to collar this thing with a married option that's 3 to 6 months out in expiration to protect our investment. That way we'll be able to roll it out for a profit as we do these continual adjustments, right? And we talked about the timing. I like sideways choppy. Most people say sideways choppy, I can't trade that, right? But with these type of strategies, if you're at a bottom, that's a perfect time to use our covered call or our bull call diagonal debit spread. Do that first trade, that's step one. Then when you get to the top, sell the near-term call option, buy the 3 to 6 month out put option. And you don't have to hit the tops and the bottoms just right. You just have to kind of get it above the center of the channel and below the center of the channel. And then that option expires on its expiration date. You go ahead and roll out of the protective option. We didn't talk about the covered put, and I asked you to make sure after this presentation you go and you research it. But when you start it just flips things. When you start at the top of the channel, you're going to short the underlying, or you're going to buy a put option trading at parity. Then at the bottom, that's when we sell our covered put, buy our protective call, covered put expires worthless, rinse and repeat, rinse and repeat. So make sure you have all 4 of those strategies. We only talked about 1 or 2 of those strategies today, but make sure you can flip things on its side because I think you're going to need those in 2024. So just a quick, I'm already at the 2 at the 2 o'clock mark. I'm just going to take 5 quick seconds here to ask you, how would you like to never miss a pick? Minimize the amount of time you spend away from your loved ones, have support when you need it. It's about getting the time, saving the time, getting the clarity, getting the results. I'm going to take a couple moments, tell you about my program. It might be a fit for you. It's for people who don't want to have a lot of data subscriptions. They want everything they need in one place. Somebody asked in the question and answer area, where do you find these picks? We actually have screeners that help us narrow down and find those perfect sideways choppy channels. That's part of the program that we offer, but you can also program those in and look for sideways choppy candidates, however you want to find them. You want more time spending doing other things. You don't want to be doing this alone. Again, analyze your lifestyle. Maybe this would be a fit for it, maybe not. But if it is, we're a good place to pick it up from, right? Because this is for people who want consistent and reliable results. So we've got in our program, we've got video tutorials, we have monthly lecture series and all their replays going back to 2007 when we started this program. This program's been around 16 years now. We have all the screeners that I just mentioned. Also, we have cool planning tools that we give everybody that help you determine how much of your portfolio you should put into each position and what your exact trade plan, what are the rules you should follow in adding each one of those positions. My favorite part is the Thursday workshops. This is where everybody comes. They're interactive, so they're not just learning workshops, but you actually bring your worksheets, bring your candidates. We pick one candidate out of all the candidates people bring that look like it would be a good trader, and we plan it out together. And if you don't come to the live workshop, you can watch the replay, and we give cheat sheets so that everybody can trade that position. In fact, we have a lot of folks who love those Thursday workshops so much, and I ask them, you know, at the end of the program, why they keep continuing. I'm like, didn't you pick it up? Why are you still coming back for more? And they're like, why wouldn't I? The Thursday workshops are the best place to find candidates, right? You always say leverage with Clyde. So for those people who want to keep going with, you know, expert fishermen, this is a great place to pick up candidates, right? And my other favorite part is when you do plan out trades on your own and you are managing trades on your own, these, you know, adjustments, and you want have somebody to look over your shoulder, we have a trade review process where you send us your trade plan, you send us your trade log, and we'll tell you whether or not, you know, you've looked at you've checked off all the boxes and you've got it right, or if you're missing something so that you don't do something silly. So really, the question is what's all of that worth to you? I also have a double your money back guarantee. So I am going to ask you to do this for 6 months, not because I think it's going to take you 6 months to pick up. In fact, I think if you watch the video tutorials, you'll probably pick it up in a couple of weeks, but because I want you to come to those Thursday workshops and go through the process over and over. Repetition is king. And I want you to have the trade review process for 6 months before I let you off on your own. And at the end of the 6 months, if you're not consistently making profits, I'm going to return your money ×2. I'm going to give you twice back your amount that you paid us to learn, right? So that's a double your money back guarantee. The other thing is, as being part of the Traders Exclusive event, I'm going to give you one of our paid coaching sessions free. This is where a coach is going to sit down with you, look at where you are, and look at where you want to be, and help you navigate the straightest path, you know, what you have to do and how long it's going to take you. So this is really invaluable. So add those two things to that list and just ask yourself, what's it all worth to you? Now, if you go to my website, you'll see that it costs $597 for the 6-month program. That's a flat fee, 6 months of access, no other charges, right? But for being part of the Traders Exclusive event, I'm dropping it by $100. And I'm giving you all those bonuses. So here's what you do. You go to optioninvesting.org. It's singular, optioninvesting.org/TradersX for Traders Exclusive, Traders X. And make sure you put in the promo code 100, and it's case sensitive, DISC. In fact, I have it up right here, and I always like to test it to make sure my programmers have put in. So let me, I'm at that optionsinvesting.org Traders X. In fact, I'll go ahead and I think I can put that right here in the chat box. In fact, somebody already did. That's awesome.
Yeah.
That's awesome. And then I'll put in here the 100 DISC, and I'll try it right now in front of everybody just to make sure where it says promo code 100 DISC.
Gotta be
Sometimes
capitals, right?
got to be capitals. Sometimes I totally am have mud on my face, but today it worked, so that means my programmers backed me up. This is how, folks, you can be part of our program and take care of all the benefits. If you have any questions, you could, of course, talk to the folks at Traders Exclusive or even just give us a call. And that's my whole presentation.
Did I put the right number in? 970-266-8146. Cool.
That'll
And
get
of
right to
course, you
our
got a
main
QR
office.
code right there that'll pop that on your device. We put the discount in there. Now, what is the best email if they want to email you?
AJ
Mm-hmm.
at tradingtrainer.com. TRADING
Got it.
TRAINER.com. Feel free to email me, folks. I love it.
Thank you so much, AJ. I appreciate you being with us, and I look forward to next year. Happy holidays and be
Thank you
safe.
so much. Thank
All
you.
right.
Bye-bye.
Bye
Thanks,
now.
everybody.